Hello, everybody. Welcome to Friday in the Talk Money with Tom show. Today, we are here to try to help you improve your retirement through questions and answering those questions. So, feel free to send in your questions. As we're going here, we'll try to answer them live. You can send them during the week if you want us to look at them in more in depth. But you can send them to the email address that's listed here, asktom@talkmoneywithtom.com, or put them into the chat, and we'll try to answer them live. We try to answer questions about, retirement planning, asset management, and tax planning during retirement. And again, whether you're retired already or not, a lot of these things are still important to take a look at just to continue your education and get better at the financial part of your retirement. And so we created this channel, Talk Money with Tom, just to try to continue the education. It's free. You can subscribe, hit the bell button to get notified when we put new information on there. And then, of course, if you'd like, you can just come meet with us if you want to, talk personally about your situation and ask us some questions that way. We have a book appointment button that looks just like that. It's on our website. Link to the website's here on the channel. You'll see that button up in the corner. So you can set up a 30-minute time to meet with Ethan and I to talk about, whatever it is that you have on your mind at this point in time. So looking forward to today's show. Thank you very much for joining us. And I want to start off the show as usual, just talking about kind of what we saw happening in the market. There's a lot going on, as usual. There's been a lot to talk about. So let me switch over to the chart here. Okay, so really fascinating. Today the market's up, 1.5%, pretty good move.
Be 9 days in a row if it closes positive.
Yeah, 9 days, right? So that's a pretty big run. And so I'm getting some questions about, why we're not moving back in and what have you. So just to reiterate, we removed our equity or stock market, exposure for our clients. We went from 63% exposure that our average client had down to 23%. And again, some of our clients are at no exposure and some are at higher, but we left the stuff that had high capital gains. In my opinion, we haven't gotten to a position where we should be taking high capital gains. We took some gains, but nothing of any real substance. So that could change. We'll talk about some different things. This week we had a lot of things going on, actually. We had the report that came out for inflation, which is important, the PCE, personal consumption. It was down at 2.6%, but for the quarter it was 3.4%. And compared to the previous quarter, actually 3.5%, compared to the fourth quarter last year, it was 2.5% for that quarter. So, inflation is picking up, likely because of the tariffs and people are going out and pre-buying and what have you.
Yeah, a lot of people are trying to get ahead of the curve by buying stuff that's still in stock.
Yeah, and the gross domestic product report came out. It was negative, right, for the first time since 2022, negative 0.3. Although I think you can discount it quite heavily because the way the gross domestic product works is imports are negative, and there were a huge jump in imports for the same reason. Everybody trying to build their inventories prior to the tariffs hitting. And so I think that's one of the big picture items that's happening. And just to understand, it's very, very fascinating. Lots of sales happened in the first quarter, and some of it's pre-sale, so that people built up their inventory. They may not be buying that much inventory in the future because they already have some. Consumers went out. We heard stories about Apple stores being crowded, and what have you. Went out and bought things prior to the tariffs hitting and what have you too. So we've got all these pieces happening and whatnot, and it's really kind of it's sort of a mirage, right? I mean, we've got this, sales up. We've got retail sales were up tremendously in March, for example. And so the real impact's going to probably come later. And we'll talk about that here in a minute. But so, again, we're in T-bills, ultra short-term bonds, treasury bonds. We still have our regular bond positions that we have in our normal models and all those types of things, but we're down to actually a 22% exposure now in the equity market. And so, we just had 9 days in a row. Why aren't we making a move to get back in, right?
And there's been economic data showing softness too.
Oh, yeah. Yeah. It's coming. And so it's sort of like, it starts at the ports, right? In China, you got 60% less shipping. Eventually, we have less of those ships coming into our ports here. It hits the dock workers, it hits the truckers, right? And then eventually you end up with shortages in retail, shelves that are empty in some cases. So probably less retail employees needed if there's less to sell, right? But it really hits very early an area that's not being talked about, which is the small business. You know, maybe Target or Apple had the ability to go out and preload a huge amount of inventory, but a lot of small businesses don't have that much capital to be able to do that. 80% of the people that work for a business here in America work for a small business, and 80% of the capital expenditures come from small businesses. We never talk about small businesses. We're always talking about
Yeah, because
Apple and what have
the
you.
small businesses don't really affect the S&P 500.
No, they don't. But they do affect the overall economy, which then affects the S&P 500. So that's where you're going to see the biggest impact coming in the fastest, is because, you know, these companies that happen to have their production done in China and they can't get it done anyplace else, they can't even afford the tariffs to reorder. And so they're just not reordering. And they're going to run out of probably inventory sooner than others. Lots of stories about, you know, there's a paper mill, a town of 22,800 people. The paper mill started in 1800s. They're closing down because of the tariffs, you know, and it's going to be a big impact to this town. And there's toy companies. I mean, I've read dozens and dozens of stories about small businesses that are right on the edge right now. And so these tariffs are going to hit, and we're going to start to see then probably some higher unemployment. We did see first-time unemployment claims went to 241,000 this week, and so that was maybe one of the signs. Now, however, we also saw that today new job creation went to 177,000, right? The expectation was 138,000. So again, we're getting this kind of bifurcated, you know, motion. Things are still, at least in hindsight, still growing, right? Matter of fact, the GDP, if you take out the, you know, massive jump in imports, estimates were, it was roughly around 2%, which is not a bad number for the quarter, as it turns out. So, you know, but we're looking forward here. And so the market's going up because there's, you know, so much pessimism in the market. When you get that, the reverse tends to happen, because everybody who's worried about the markets in the future, like we are already out, and that leaves the buyers to come back in. And then you have a pretty good amount of these quant, you know, programs move in the market in today's world. They don't care what's happening. They don't even look at any data whatsoever. They just are, because they're very fast traders, and, you know, they can take advantage of this. And so I'll show you a couple things to understand about some of these downturns, and so kind of from where we're coming from. So this is a chart. I think a good way of looking at it. So this was the, you know, 2007 to 2009 downturn. I call it the 2008, you know, downturn. And, you know, if you look at that, there were 8 times that this thing rallied, right, between 7 and 24%. All the way to a negative 57. So just because it's coming up doesn't mean that it's going to be turning around tomorrow. Now, the one thing that is different about this is if tomorrow they got rid of all these tariffs, I mean, unilaterally, not just the China one, which is the big one that has to be dealt with. And we are hearing, you know, back and forth noise from both parties saying that some conversations are starting, which is good. Kind of wanted to see that this week. But the stories you read out of China is they're expecting this to last for the entirety of Trump's term, was what I read today. So, you know, but they want to see tariffs come down, you know, to a more meaningful level than they were talking about 40 to 50%, which would still be, anyway. So, so rallies happen in downturns, and we are in a primary direction downturn, right, by all the check boxes that I have. And so when the market goes up, when the primary direction is down, that's the minor move, not the major move. And so that's what you're seeing here in this 2008 downturn. Lots of minor moves, 11%, 7%, 12, 7, and 24%, right? So lots of, you know, motion and things that are happening as far as that goes, all the way down till we finally hit some bottom. Now let's take a look at a more recent time frame. This is 2022, all right? This just happened. We hit a peak, and then inflation hit. In the end of 21, we started hearing about, from the Federal Reserve, November of 21. I remember even it was Thanksgiving that Friday. The Fed was out there hammering the market with their comments about, what was going to happen with inflation and raising interest rates. And so you saw, I got arrows on two of the big rallies. Right over my head is the bottom. That's October 13th, 2022. So that's a 28% drop from high to low. And we had the first arrow there, that's a 15% run up. The second arrow there is an 18% run up. So why did those fail? I mean, what's the fundamental issue that was going on there that caused those to fail?
So we were, during the 2022 was inflation and the Fed was raising rates.
Right.
And so these were speculative moves before the Fed actually paused rates or started to cut rates.
Right. Some hope that they might, that gets dashed by the Fed still coming out. I remember that period very specifically because the Fed actually wanted, in my opinion, the market to come down because that would help them with their inflation fight, right? Because if you make people feel poorer, at least temporarily, they'll spend less, right? And so, that big peak at the 18%, there was that Jackson Hole meeting, and Powell came out very negative, and really just drove that whole market all the way down till October. And so that's the key here, right? So when you look at 2022, you see those big run-ups and you think, okay, great, the market's coming back, but it didn't because the underlying issue was still there, which was raising interest rates, okay? The underlying issue for this is still here, right? So let's take a look. The Smoot-Hawley, okay, this was passed by Congress back when they used to do that in June 17th of 1930. So it was a 20% average tariff, but it was only on 25% of the imports that were coming in. They selected different things. It wasn't the broad-based thing like we had here. So the Trump tariffs right now are higher than that, 22.5 to 22.7, depending on kind of what you're listening to. But these are much broader, okay? So our average tariff will drop when they get rid of that 145% and get down to something more manageable tariff against China. And so that could bring our average tariff down below what was happening here in 1930. But when you look at the broadness of it, it actually is expected to be higher than what we had in 1930, because right now we have a 10% tariff basically on everything. They've made some carve-outs, right? So some of the pieces for automobiles were carved out this week. And the 10% is still, actually I think Apple still is sitting on the 20% tariff for their stuff coming in from China. They were relieved of the 125% that was added on. But still at 20, that wasn't there before. And the 2018 tariffs were pretty small, 10% on certain items coming out of China. And that stopped. The Federal Reserve started lowering rates. The market came back pretty quickly. This is significantly bigger than that. Matter of fact, this is the biggest since 1909, where we're at right now. So if we look at, so that's my underlying thought process here, is as long as this situation is in play, we have to be careful, right? Because here's the that's when it was passed, right there. In the Great Depression, and it's credited with exaggerating that. And the idea behind it, if you go back and look and study this, we were at a little over 6% unemployment at the time.
Yeah, and the idea is with tariffs, you protect local industries, and then local industries will start producing, and then they will employ more people.
That's right. So they were trying to reduce unemployment from the 6%. So it seemed like a good idea, although there was a whole bunch of economists at that time, just like now, saying, hey, this isn't going to work because there's going to be retaliatory tariffs, which is exactly what happened. And unemployment went into double digits and stayed there for a really long time. And the big bread lines you see and all that. And so even now they're talking about, yes, this will create some jobs, but there'll be more jobs in general lost in total. And so tariffs have the reputation, especially at the level that we're talking about now, of creating much higher unemployment, right? And so this was an 87% drop from high to low. In my opinion, you just can't sit there Unless you have high capital gains, because the tariffs could disappear. They could get rid of the 125% extra tariff on China next week. There are enough things that can be changed by stroke of a pen, so to speak, or just by Trump deciding on something else, that we could avoid all of this, okay? But as long as it's there, you've got to assume it might stay. I mean, China might not come down, right? And so China's at 125% on the U.S. What if they don't come down? Is the U.S. going to drop it down below 125? I mean, as a negotiating point, I probably wouldn't. That puts us in a position of weakness. So there's pieces where you can make an argument that this is going to be difficult to solve, and there's situations where you can make an argument that this will be over next week. It's possible. So someplace in between there is probably reality. And in the interim, we're already having some damage that will have an impact. But I do think if they rectified tariffs fast, and reduce them dramatically from where they are now, I do think that would, whatever gap we have right now, 2 months, 3 months of suffering through shortages and maybe even some price increases because of those shortages, the market will look past that because it'll know, where the tariffs are. So there is a possibility here that the market goes, which is why you don't want to sell your highly capitalized, your highly capital gain stock, in my opinion. So where do you go? Well, this is kind of interesting. We take away that weekly summary. There we go. This is risk level versus, the reward. Risk versus reward. That's a pretty cool little chart. So if you start at the bottom, right, the least risk, okay, not much reward either, honestly, but better than nothing. Treasury bonds and T-bills. And that's mostly where we are with our assets that are not in the stock market. And then CDs are next, which is kind of interesting. CDs aren't as safe as a T-bill, for example, because it's just the general obligation of the bank. If the bank fails, then the FDIC steps in. But the FDIC isn't the Treasury. It's not a direct obligation. If you look at the Heritage Foundation, who wrote Project 2025, a lot of their stuff was talking about eliminating the FDIC. Now, they didn't put that directly into Project 2025. They talked more about reorganizing the FDIC and combining it with several other groups. And then it's a little vague as to what would happen with the insurance for the CD. Mm-hmm. So that's why T-bills are the place to go for pure safety if you're just trying to ride out something big. And it just keeps going up: bonds, dividend stocks, cryptos at the top, penny stocks, and those types of things. So just that's where you kind of want to hide out, is in that T-bill arena. If you look back at the Great Depression or even 2022 or any of these time frames, the T-bill would have been a good winner in that time frame. Gold comes up quite often, and it's been a great diversifier so far. But when things really hit the fan, gold gets sold. At least that's what we saw in 2008 downturn. It's a store of value, so people will sell it because they need that money as far as that goes. So anyway, that's our summary, for the week. Just trying to answer, why we're suffering in a way because we got out through a 9-day up run. But the underlying piece that is causing the downturn in the first place hasn't changed at all. There hasn't actually been one single announced, negotiation that has been finalized. I know the rumors are that India is right there. Maybe that happens pretty soon. There's probably others, although I've heard Europe is really doing something similar to China. They're just kind of standing back. And so, that hasn't gone very quickly, right? So, there are some pieces that could be done, but there hasn't been anything done. And so you've got to assume, you've got to take where we are today and say, okay, and honestly, do we really think Trump would wipe out all these tariffs? Would he get tariffs down to a point that are below, on a net basis, where we were in 1930? I'm not sure. Certainly he's not talking about that. It's not what he's saying. He might respond, as I talked about last week, to a falling Treasury market, because that's a big deal, makes yields go up, which is exactly the opposite of what he's trying to accomplish. So, and that's why we got the pause. So it's possible. We'll see. But this is again, I look at this as playing, we're going to play soccer on a minefield. It might work out, but the risk doesn't, the reward doesn't outdo the risk in that particular situation. That's kind of how I look at this market, even with this nice run-up. Again, we had great run-ups in 2008, great run-ups in 2022, both of which had multiple failures in those run-ups. So the only way this run-up doesn't fail is if the underlying condition changes. You could go right back to an all-time high if you get that situation where, you know, they eliminate the 125% tariff for China. I think that would probably be enough to really get it to go. The Federal Reserve cuts rates, although now they're talking about May 7th, you know, next week they're meeting, but the job report came out. It was very good. So the Fed's not going to. I think the bet is 98% chance that they don't change rates.
They're going to sit on the sidelines
Right.
for a little bit longer.
And June went from a majority futures market believing rates would drop in June to now the majority is that they won't drop, just from today's report. So the Fed isn't going to step in and kind of make that push that would help the stock market. It looks like, unless there's some other soft data that comes out. Unfortunately for the Fed, the strong data is still there because of all these purchases that have happened for people responding to, you know, the possibility of tariffs, both businesses and consumers. So I think it'll be a little while before we see the Fed step in because they won't really have the justification to do so. As far as that goes. So anyway, that's the summary for this week. Kind of let you know where we're at and how things are working as far as that goes. I'm hoping for the best. I hope that this rally that we're on right now just keeps on going, that they get the tariffs under control and, you know, allow the Federal Reserve to maybe start lowering rates again and we can take off and go. But as far as, you know, we have to play with what we see right now, right? And so that's the issue. All right. What's our first question?
Can you explain the process to what you decide to sell and how do you decide what to purchase back when you enter back into the market?
Okay, this was a question that was sent in by a viewer this week. Basically just looking at his portfolio and saying, okay, what do I sell? Yeah. And then, you know, what do I buy back in, right? All right, so as far as we're concerned, first of all, I'm sure this is pretty basic, and I just want to make sure everybody understands. You want to be selling your stock market exposure. You don't really need to sell your bond market exposure at this time, in my opinion, unless you have some really crazy stuff in there, because high-yield bonds can sort of act like stocks, right? So maybe you would pick on those. But let's say you have a target date fund. Target date funds can have, you know, anywhere from very little stock to very high level of stock. If you're going to reduce your exposure to the stock market, you want to go through and figure out what is in the stock market and remove yourself from those. And again, the caveat there being, at this point in time with where this situation is, I would not be taking anything that has a high capital gain. I would keep that and ride that out. Let's wait and see what happens for a little while before we start doing that. And hopefully we won't have to, because the market will come back and they'll get the tariff thing under control. But if they don't, you don't want to ride through the next Great Depression. I mean, the last time we had these level of tariffs was a depression. So you don't want to ride through an 87% downturn even with your highly capitalized stock. You're going to have no gains pretty quickly. So, but that's a future conversation. So first of all, just identifying your stock market exposure, sell that, move into T-bill ETFs, in my opinion. It's the safest place to go during this type of potential crisis. And then when we're buying back in, so for us, we have what we call our core and our target, right? So our core pieces are our biggest piece, usually make up like half to 3/4 of any one of our model portfolios. And then the rest is this target pieces, right? And so, and the target pieces can be anything that is moving up on our list. So, you know, it could be Europe, it could be whatever is happening out there. So that's how we look at it. We would move back into core first. And core is things like the Vanguard Total Stock Market Index or the Vanguard Total World Index or, you know, the Vanguard S&P 500 or, you know, any version of those. There's a whole bunch of different companies that have different versions, but that's the type of things that we like to have in core. Wildly diversified exposure across the board, so that if the market's moving any one direction, we probably have at least something covered in that particular type of mixture. So it might be, for example, half Vanguard Total World Index and half Vanguard Total Stock Market Index, which is all U.S., right? And I think that Total World there's overlap there, obviously, because they both have the U.S. in it. But the total world is something in the neighborhood of 9,000 stocks. I can't remember the exact number. And then the total U.S. piece of that is over 4,000 stocks. So that's your, your buyback in is with this broad pieces. And then you start to take a look at like what's moving, what's working really well. And so our targets are meant to kind of rotate and try to capture that momentum. So as things come back, we'll go back in on core first. And then as things develop, we'll start to, use our list. We basically have a proprietary, concept of how we find momentum and how we move back into those pieces and let them ride. And sometimes, unfortunately, if the market's falling apart, the things that are doing really well are the T-bill pieces that are on our list, and we'll wait until they something else starts to get in front of them before we come in. So those will be later because of that. That's how we work it. And so anyway, that's the overall answer. Sell your stock stuff. Don't sell your high capital gains. Be ready with some type of a model to buy back into as things change.
Would you recommend this strategy for an average investor that's kind of just investing every month, or would you kind of is this something for someone that's more actively as an investor?
Well, yeah. I mean, if you're dollar cost averaging into something, this would not be for somebody who doesn't have a lot of money in the market just because they're still starting out or what have you. You just want to keep on dollar cost averaging at least for a while here. If this, it took 5-6 months for the Smoot-Hawley Tariff Act to really hammer the markets and the unemployment, right? So if we're still sitting at 145% in September, I don't care who you are, you're probably going to get killed. And we just have to be careful. People are discounting the possibility of a depression. I'm not. So that would be the difference. We're not there yet. So at this point in time, my recommendation would be to keep adding, keep going, keep doing the dollar cost averaging. Again, this is a manufactured crisis. We have a group that is in charge that could change their mind, and you'd be very happy that you continue to buy throughout this. And so, the damage has been done, but not enough to create real problems. If they reverse what's been done so far, the market's going to ignore whatever damage is going to happen. It's going to look past that, whatever worries that we have about this summer. If the tariffs are all taken care of in some manner that works for the market and works for the economy, all of this is going to blow over. It is going to be this small downturn. It won't mean anything. But I tend to look at where things are today and try to react to that. And that's when in 2022, they were still raising rates. So those big run-ups, until they stopped raising rates, they weren't going to work. So it's the same thing here. This run-up will not work if these tariffs stay where they are. I can almost guarantee that. But I can't guarantee that they won't change their mind on these tariffs. So that's the hard part. That's why I would say, if you're dollar cost averaging and those types of things, if you have significant principal and you're in a situation like a lot of our clients where you're retired or about to retire, I'd be a little bit more cautious. I'd be happy to give up the potential rate of return that we've been getting the last 9 days, just to know that my retirement is still okay, and that things don't turn around so quickly on me that I can't get out of the way, because downturns can be very fast, right? We saw that in the pandemic. So that's where, again, it depends on who you are and how much capital you have at risk. Still keeping the high capital gain stocks. But in terms of reducing exposure otherwise, I'm a 20-something-year-old. I got $5,000 in VTI, and I'm adding $100 a month. Don't stop. Maybe ever, honestly. But I'm 74 years old. I have $5 million in the market that's supporting my retirement. Of which, say, 60% of that was $3 million of it was in stock. I would reduce my exposure to the stock market if I'm that person, at least for now, especially if I can do things that aren't going to cost me tax-wise, right? Just to sit on the sidelines, reduce some of that exposure so that if things continue to stay the same way, and then if the market comes back to the point where, because of the tariffs being better, then I'd be back in, So anyway, that's my outlook.
So, why do short-term Treasury ETFs drop every month?
Yeah, it's kind of funny. I actually have a chart. Let's see here. So this is a daily price for the data for T-bill ETF. So it's through Spider, which is State Street, right?
Yep.
It's one of our favorites. It's a 1 to 3 month T-bill. It's nice and conservative. The ticker symbol is BIL, right? And so you can see this goes back for a couple of years here, and they rise in price as basically the interest accumulates. I mean, these T-bills are designed to basically move in price up to a certain point. You can see the point there. And sometimes there's some variations, but
Depending on where the interest rates are.
yeah, exactly. So they are interest rate sensitive, not as much as most, but and then they pay it out. And so those big drops are the payouts. And so, for example, what was it, yesterday, we saw like this drop 0.3%,
Yep.
right? Which is like, wow, that's a lot for a T-bill to drop, is because it paid that out, right? So I also have a chart of the cumulative. So this is where you put those dividends back in, right? Same time frame. And then you can kind of see what I'm talking about. That's pretty smooth, right? They just march along. They'll pay more when interest rates are higher and less when interest rates are lower, right? I mean, but they are considered the risk-free assets. You know, in finance school, in college, you know, we learned what's called the capital asset pricing model, right? Well, this is a way to determine what a stock should be worth based on how much its volatility. They use beta in that, but you have to have a risk-free asset to use as an example. And so the risk-free asset is the U.S. T-bill, right?
Yep.
It is the safest asset on the planet, even with all these problems that we're having and all the different things that are happening. The T-bill, if the T-bill isn't safe, you won't have a place to go, right? So that's where you want to put it, right? It'll stick there, I think. So anyway, that's a good question. It's kind of fascinating. I mean, you go from, you know, there what it looks like without the adjustment for the you know, the payouts. So if you see, you know, you're watching the charts and you see, you know, this T-bill thing dropping, because we got some questions about this. Hey, you know, why is it dropping so much when it's not supposed to be? It's supposed to be the safe thing, and this is what it really is. So you just have to take a look at what the dividend
Yeah,
is.
and there's going to be a lag period between the actual dividend paid
Yeah,
and
that's
when
right.
it's announced. And so that's where you see this drop right now in the adjusted returns, but it'll return back to normalcy in
That's
a
right.
couple days.
That's right. All right. Good question. What's our next question?
So, this question comes in. Let's see. I think it's a security question. So we may want to skip that for next week and then research into it.
Okay.
But how long will it take to see the effects of the China tariffs?
How long will it take to see the effects of China tariffs? Ooh. So Michael Burry, who is the guy that, the Big Short, he's actually local here. I forgot how much he made in the big downturn in 2008. It was ridiculous. He says, you know, empty shelves by June, right? I think we're already seeing the impacts to small business. The articles I'm reading, and so you're starting to see those impacts because small business didn't have the ability to really ramp up their inventory as much as they might have if they were bigger. But in terms of the economy, you know, June, July would be my guess. We'll see some impacts. We'll see some layoffs. Layoffs are already happening. We're already seeing first-time unemployment start to creep up. I mean, there was layoffs from DOGE, from the federal government. Some of those have been rehired back, and it's a little murky as to what's happening, but some of those people are going to end up on the unemployment rolls. But more likely, it's going to start with these small businesses. Like this, like I say, this paper mill company that from 1800s, they had 800 employees. They all got laid off just this week. And so they're starting to see that type of stuff that'll kind of creep through the economy. Again, in terms of what the stock market's going to look at, it's not going to care about that if they've resolved the tariffs.
Yeah.
So in a short period of time, before those impacts, let's just say the impact's June. So if before June, the tariff situation is something the market likes, whatever that is, the market's not going to care about the impacts that are coming because it's a temporary impact. It might go for 2 or 3 months because we went for 2 or 3 months to get those tariffs to where they needed to be. We would get this gap that comes through. Some of that gap would be lessened because there are a lot of inventories out there, and some might be able to squeeze through some of those gaps for some of these companies. But really, but it'll start hitting soon. But what it means to the market has a lot more to do with what is happening with those tariffs and those tariff negotiations.
Yeah, because when tariffs don't actually didn't affect anything in transit. So once they got on the water and they were in en route, and so that takes about 20 days, I guess, to ship from China by ship, and so you have a 20-day lag period just on those
Right.
shipments.
Right.
So people that got shipped ahead of the tariffs, they may have a smaller tariff that they were paying, and so a lot of them have stopped, and so the port of Los Angeles is expecting 35% drop.
35% drop. So it hits the ports first. Again, that could lead to layoffs, and trucking would come in next, and other types of transportation would be part of that hit, and then eventually you end up with shelves that don't have as much on them at the retails, and so you end up hitting retail. There's 19 million people in retail. There'd be less people working in retail if there's less to sell. However, all of this could be stopped because even it's the same thing. I own a retail store of whatever type, and I'm starting to feel the pinch, and I'm wondering if I'm going to have to lay people off. But all of a sudden they announce the new tariffs, and that works for me. I will suffer through the couple of months to keep my business in the same spot. The port would suffer through what it has to do. Trucking companies would suffer. So it all has to do. It all keeps coming back to the same issue, is what happens with these tariff negotiations, and in the end, are they amenable? So if it's still, even after they've done everything, and we still have tariffs that are higher than they were in 1930, I don't know that the market's going to think that's great, and I think that the impact to the economy can continue to be a problem. But it could be less than that, and it could be more and more carve-outs, which is what they're doing right now to lower tariffs. Did a little carve-out this week for automakers. They did a carve-out, obviously, for Apple and those types of companies selling computers and iPhones and what have you, to lower the tariffs. They're still higher than they were, but so it's the same story. It's going to come back to what happens. The effects are going to be there. We'll see them. It'll be frustrating if you really want something and it's not available, but it won't have a massive impact on the stock market if the tariffs are reduced to a point that the market is okay with that. So we'll see.
So what does the April job report mean for interest rates in general?
Whew. Okay, so the April jobs report, the expectation was 138,000 jobs. There was 177,000 jobs created. That's a pretty good number, actually. I mean, just historically, that's not a bad number of jobs created. But it really factors in with what the Federal Reserve is going to do. The Federal Reserve has a dual mandate, what they call full employment, and actually today's report also showed that unemployment didn't change. It was still at 4.2%, which is right within the range of what they consider full employment. So they're not going to feel a need based on the job market to lower rates. Okay, first-time unemployment claims did jump up, and so maybe they'll respond to that because that's what makes them want to lower rates. But then you get this jobs report just today, right before their meeting next week. They meet Tuesday and Wednesday of next week. I don't think it's going to compel them to want to lower rates. And again, when you look at the futures market, the bet right now, I think it's 98% chance that rates don't change in May.
Yeah, they basically are just going to sit on the sideline. There's no incentive for them to act proactively.
Right, and of course we already discussed even for June, which had a majority, I think it was 55% chance of a rate cut, is now 65% chance of no rate cut, right? So that changed today also because of this jobs report. So this April jobs report means that interest rates will likely stay where they are, although the Fed doesn't control interest rates completely, as we've seen actually. I mean, the Fed didn't change rates, and all of a sudden we saw the yield on a 10-year go from like 3.9 to 4.5, right? Because of market forces, because the market was freaking out over those, Liberation Day tariffs. And it settled back down, although it's still higher. than it was.
Yeah.
And so it means higher rates at the moment, in my opinion. Something needs to really break. We need to see some more problems economically. And we're just not going to see those because of this artificial sugar high that we're on from all these purchases, both for inventory and consumers prior to the tariff. It ironically stimulates business, at least temporarily. And then the other side, one of my concerns is when you've already spent all the money. If I was going to buy an iPhone in September, I bought one in, February, March, I'm not buying in September. So all those people that were going to buy in September, do we end up with a big gap on the other side in terms of revenue wise, so that I think that will be an issue. One thing that's not being talked about, McDonald's just said that they're seeing a big drop off in their international sales because they're an American company, right? And so that's the boycott effect, which doesn't even have to have a tariff on it. You could see some impacts starting fairly soon on company revenues. Does Apple get purchased as much as it would have before these tariffs, even if they didn't have a tariff, just because they're obviously an identified American company? We've seen Kentucky get hit by the Canada, boycott basically on their whiskeys and things along those lines. So, I mean, there already are some pretty big impacts that are happening just because of the global tensions that are caused by what's happening here too.
So, what are your thoughts on using a Roth IRA as a flexible way for education savings? I had a child in my 40s, which is a bit later than the average, and I may have access to my money when they start to attend college.
Okay, so I'm not sure I get the whole question. So,
What are your thoughts on using a Roth IRA in place of maybe a 529
oh,
plan?
got it. Yeah. Okay. So, to pay for college education costs,
Yeah.
and you're in your 40s?
Yeah. So if you had your child in your 40s, and let's say you're going to turn 59, let's say you have it 40,
Uh-huh.
so then you'll turn 59 and a half in 19 and a half years.
Right.
You'll be able to have access to that Roth money in a tax-free growth.
I think it's a brilliant strategy, especially for that situation where, your child's going to be in college when you're 59 and a half or older, right?
Yeah.
And, one of my friends had kids. He was over 60 by the time his first child got to college. So, yeah, that'd be a perfect idea. It's a little limited into how much you could put in there, but you could start pumping money into a Roth. You have to qualify too, right? I mean, you have to have the right amount of income. If you have too much, you can't do it outside of the backdoor Roth.
Yeah, right now it's about, I believe it's 100, the phase out starts at 150,000.
For a couple?
For single, and for a couple it is 236,000.
Okay, so if you're under those values, you're old enough so that your child will be in college when you are 59 and a half or older. That's a great strategy, right? I mean, because you get the tax-free growth. You don't have the limits on what you can take it out for like you would with a 529. You can invest it wherever you want. Those 529 plans, they have fairly high expenses.
Yeah, and they give you a limited options
Very much
pool of investments.
Versus you can invest in anything in your Roth IRA and really find some good things.
The nice thing about a 529 plan, though, is you can contribute more. There's
Yes.
no limit on how much you contribute to a 529 plan.
Right.
There's a cap on how much value you can have in one. But in theory, you could go above. Most people stop at their annual gift exclusion,
Right.
Because then you have to actually start paying taxes, or it goes into your estate tax.
Yeah, and you can front load 529
For 5 years.
For 5 years, which is
And then
what,
other people.
75,000. I think.
And
you
then
could
the nice
put
thing
in.
is with 529s, other people can contribute to it too.
Yeah, exactly. Yeah.
So I think it could have a good use. It's a very niche. You have to have a very particular situation where it works.
You do.
But it offers a lot more flexibility.
Yeah, because it would be nice if your kid doesn't go to college or if the costs aren't that high. You still have this Roth IRA to use for yourself,
Yep.
for the long term. It's tax-free, just like the 529. Sounds to me like, you kind of max out the Roth, and then if you have more money, you start putting in the 529. You can kind of use both that way, right? And so that's an interesting question. It's like you say, if you're in your 20s and you've had a child, that probably won't work because you're going to end up with penalties for pulling
Yeah,
money out of the Roth.
you can always pull out your contributions tax free,
Right.
and there's also a little bit of exclusion from the penalties
Right.
for higher education, but it's not. It wouldn't be the right plan for that situation.
Probably not. Yeah, once you ran the numbers and really looked at it, might not work out as well. Okay, good. That's our show for today. Thank you very much for joining us. Looking forward to being able to, answer questions. We got one live today that we want to do a little research on. Sorry we didn't try to answer that, but we'll get to that next week. You can send in any questions that you have to Ask Tom at talkmoneywithtom.com, and we'll try to get ready for those for next week. And then of course you can subscribe to our channel, hit the bell button, to get notified when things come, or set a time to meet with Ethan and I. Go to our website, book appointment button's right at the top, and we'd be happy to meet with you. So thank you very much. Really look forward to being able to see you again next week. Have a good one. Yeah, that was the first meeting.